Hello, I hope you have watched the first two videos. Gist of many principles and concepts of corporate accounting, which was facilitated by the learners. So now we'll be learning few more concepts, glimpses, or gist from corporate accounting. All the best to you all. Pay attention, take notes, take at least the hints. It helps you a lot to attend the MCQ. Best wishes.
I'm going to explain about notes on account in balance sheet. Balance sheet is a statement of the financial position of a business organization on a given date, which helps stakeholders in analyzing its future prospects. It also summarizes the asset, liability, and shareholders' equity of a business organization at a given date. It provides a base on which rate of interest can be computed and its capital structure can be evaluated. It is also known as statement of financial position and account note. The balance sheet is one of the three major financial statements: income statement and cash flow statement, which are necessary for conducting fundamental analysis of the business and calculating its financial ratios. A balance sheet can only represent the financial position of a business at a given date. It cannot represent varying trends over a longer time period. Objectives. The main purpose of a balance sheet is to analyze the financial position of a business. It also proves beneficial to the investor and creditor of the business. It informs them about what the business owns and owes at a given date. This information helps them to decide whether they should invest in the business or not. Interested parties may include business manager, current investor, potential investor, competitor, customer, supplier, labor union, government agencies. A balance sheet also helps to derive various ratios such as equity debt ratio, asset test ratio. These help investors understand the financial health of the business. The basic formula for the balance sheet is asset is equal to liability plus shareholders' equity. Let's see the segments. First, assets. Assets are the things of the value that are owned by the business organization. There are two types of assets. First one is current asset. Current asset means which can be converted into cash in a year or less. And second type is non-current asset, which can be converted to cash in more than a year. Example for current asset is cash and its equivalents, marketable securities, accounts receivable, inventory, prepaid expenses, etc. Example for non-current assets: fixed assets such as land, machinery, building, etc. Intangible assets such as goodwill, etc. Second one is liability. Liabilities are the things that the business owes to other parties. These are listed in descending order of their due dates. They may include bills payable, interest, debts, outstanding rent, outstanding salary, etc. These are two types: current liabilities, non-current liabilities. Current liabilities are which are due within a year or less, and non-current liabilities which are due in more than a year. Example for current liabilities are short-term debt, bank loans, payable interest, expenses on tax, rents, salary payable, payable dividends. Example for non-current liabilities are long-term debt and its interest, liability of pension funds for employee retirement accounts. Next one is shareholders' equity. It is the amount of money that belong to the shareholders or owner of the business. Example: net earnings like retained earnings and reinvestment by the business are used for paying the debt. The rest is distributed as dividends to the shareholders. Treasury stock, preferred stock, capital surplus. Notes to account. Account note of financial statement consists of detail related to the information mentioned in the main body of financial statement. These footnotes inform of the important accounting policies, company's commitment, breakdown of sales, breakdown of purchases, details of asset and liabilities, and potential profit and losses. Investor who only focus on the main body of the financial statement and oversees the note commit a grave blunder as they can be easily misled that way. The notes may be several pages long, but they are not to be undervalued while analyzing the financial statement of a business. The information provided by notes to accounts is for understanding and evaluating the financial statement of the company. Thank you.
Hello everyone, myself Vaibhav Lakshmi. I am going to explain about the methods of valuation of shares. ஃபஸ்ட்டு வேல்யூவேஷன் ஆஃப் ஷேர்ஸ்னால் என்னென்னு பார்த்துருவோம். ஒரு கம்பெனியில் இருக்கிற ஷேர்ஸோட வேல்யூவை நம்ம கண்டுபிடிக்கிறதுக்காக தான் நம்ம வேல்யூவேஷன் ஆஃப் ஷேர்ஸ் யூஸ் பண்ணுவோம். வேல்யூவேஷன் ஆஃப் ஷேர்ஸ் இஸ் த ப்ராசஸ் ஆஃப் நோயிங் த வேல்யூ ஆஃப் த கம்பெனி ஷேர்ஸ். இந்த வேல்யூவேஷன் ஆஃப் ஷேர்ஸ் வந்து எப்போலாம் ரெக்வயர்ட் ஆகும்னு பார்த்தீங்கன்னா, when there is the merger, acquisition, reconstruction and amalgamation and conversion of the preference shares into equity shares, implementing the ESOP னா employee stock ownership plan சொல்லுவாங்க. இது அக்கர் ஆகிறப்ப நமக்கு வந்து வேல்யூவேஷன் ஆஃப் ஷேர்ஸ் வந்து யூஸ் பண்ணுவோம். அண்ட் லாஸ்ட் ஒன் வந்து இஷ்யூ ஆஃப் போனஸ் ஷேர்ஸ் ஆர் ரைட்ஸ் ஷேர்ஸ் டு இட்ஸ் எக்ஸிஸ்டிங் ஷேர் ஹோல்டர்ஸ். இதெல்லாம் வந்து டேக் பிளேஸ் ஆனால் நம்ம வந்து வேல்யூவேஷன் ஆஃப் ஷேர்ஸ் வந்து ரெக்வயர்ட் ஆகும். இப்போ நெக்ஸ்ட் வந்து பார்த்தீங்கன்னா மெத்தட்ஸ் ஆஃப் வேல்யூவேஷன் ஆஃப் ஷேர்ஸ் வந்து யூஸ் பண்ண என்னென்னு பார்க்க போகிறோம். மெத்தட்ஸ் வந்து பார்த்தீங்கன்னா நெட் அசெட் மெத்தட் அண்ட் ஈல்டு மெத்தட் அண்ட் ஃபேர் வேல்யூ மெத்தட். இந்த ஈல்டு மெத்தட் வந்து 2 டைப்ஸ். என்னென்னா ஃபர்ஸ்ட் ஒன் வந்து ரேட் ஆஃப் டிவிடெண்ட் அண்ட் ரேட் ஆஃப் ஏர்னிங்னு சொல்லுவாங்க. ஃபர்ஸ்ட் நெட் அசெட் மெத்தட்னா என்னென்னு பார்க்கலாம். நெட் அசெட் மெத்தட் இஸ் ஆல்சோ கால்டு இன்ட்ரின்சிக் மெத்தட், அசெட் பேங்கிங் மெத்தட், ரியல் வேல்யூ மெத்தட், பேலன்ஸ் ஷீட் method or a breakup method னு சொல்லுவாங்க. Under this method, the net asset of the company including the goodwill and non-trading assets are dividend by the number of shares issued to the arrived at the வேல்யூ ஆஃப் ஈச் ஷேர்ஸ்னு சொல்லுவாங்க. அதாவது நெட் அசெட் மெத்தட்னா ஃபஸ்ட்டு வேல்யூவேஷன் ஆஃப் ஷேர்ஸ்னாலே நம்ம வந்து ப்ரிஃபரன்ஸ் ஷேருக்கு சொல்ல மாட்டோம், ஈக்விட்டி ஷேர்ஸ்க்கு மட்டும்தான் நம்ம யூஸ் பண்ணுவோம். அந்த ஈக்விட்டி ஷேர் ஹோல்டர்ஸோட ஷேர்ஸுக்கு என்னென்ன வேல்யூங்கிறத நம்ம கண்டுபிடிக்கிறதுக்கு வந்து இந்த 3 மெத்தட் யூஸ் பண்ணுவோம். அதில் வந்து நெட் அசெட் மெத்தடுக்கு வந்து ஃபார்முலா இருக்குது. என்னென்னா வேல்யூ ஆஃப் ஈக்விட்டி ஷேர்ஸ் இஸ் ஈக்குவல் டு நெட் அசெட் அவைலபிள் டு ஈக்விட்டி ஷேர் ஹோல்டர் டிவைடட் பை நம்பர் ஆஃப் ஈக்விட்டி ஷேர்ஸ். இட் ஆல்வேஸ் மீன் ஈக்விட்டி ஷேர்ஸ் நாட் ப்ரிஃபரன்ஸ் ஷேர்ஸ். இது வந்து ஒரு இம்பார்ட்டன்ட் பாயிண்ட். இது வந்து ஆல்வேஸ் மீன் ஈக்விட்டி ஷேர்ஸ் நாட் ப்ரிஃபரன்ஸ் ஷேர்ஸ். ஸோ இதான் வந்து இதுக்கான ஃபார்முலா. இதில் வந்து நெக்ஸ்ட் வந்து நெட் அசெட் எப்படி கண்டுபிடிக்கணும்னா நெட் அசெட் ஆஃப்டர் ரிவாலுவேஷன் மைனஸ் எக்ஸ்டர்னல் லயபிலிட்டி ஆஃப்டர் ரிவாலுவேஷன் யூஸ் பண்ணிங்கன்னா உங்களுக்கு நெட் அசெட் கிடைச்சிரும். அடுத்து நம்பர் ஆஃப் ஈக்விட்டி ஷேர்ஸோட ஃபார்முலா என்னென்னா ஈக்விட்டி ஷேர் கேபிட்டல் டிவைடட் பை ஃபேஸ் வேல்யூ பர் ஈக்விட்டி ஷேர்னு யூஸ் பண்ணுவோம். ஸோ இப்போ வந்து இந்த சம்மில் வந்து என்னென்ன அசெட் சைடு அண்ட் லயபிலிட்டி சைடில் வந்து என்னென்ன வந்து நம்ம வந்து இன்க்ளூட் பண்ணுவோம், என்ன எக்ஸ்க்ளூடிங் பண்ணுவோம்னு பார்க்கலாம். அசெட் சைடில் பார்த்தீங்கன்னா ஃபிக்ஸ்டு அசெட், குட்வில், இன்வெஸ்ட்மெண்ட், கரண்ட் அசெட், அப்புறம் வந்து பேட்டன், ட்ரேட்மார்க்ஸ்லாம் நம்ம யூஸ் பண்ணுவோம். அண்ட் எக்ஸ்டர்னல் லயபிலிட்டி சைடில் வந்து டிபஞ்சர்ஸ் அண்ட் பாண்டு, லோன் பாரோடு, கரண்ட் லயபிலிட்டிஸ், ப்ரொவிஷன் ஆஃப் டேக்ஸ், அவுட்ஸ்டாண்டிங் லயபிலிட்டிஸும் நம்ம வந்து இன்க்ளூடிங் பண்ணுவோம். எக்ஸ்க்ளூடிங் வந்து என்னென்ன பண்ணுவோம்னா அசெட்டில் வந்து ப்ரிலிமினரி எக்ஸ்பென்சஸ், P&L அக்கௌண்ட்டை டெபிட் சைட் போடுவோம். அண்டு டிஸ்கவுண்ட் ஆன் இஷ்யூ ஆஃப் ஷேர்ஸ் அண்ட் டிபஞ்சர்ஸ். அதே லயபிலிட்டி சைடில் பார்த்தீங்கன்னா ஈக்விட்டி, ஷேர் கேபிட்டல், ப்ராஃபிட் அண்ட் லாஸ் வந்து கிரெடிட் சைடில் போடுவோம். ரிசர்வ் அண்ட் சர்ப்ளஸ் வந்து போடுவோம். இதோட வந்து நெட் அசெட் மெத்தட் வந்து கம்ப்ளீட் ஆகுது. இதெல்லாம் தான் வந்து நெட் அசெட் மெத்தட் கீழே வரும். அண்ட் நெக்ஸ்ட் வந்து பார்த்தீங்கன்னா ஈல்டு மெத்தட்னு பார்ப்போம். ஈல்டு மெத்தட் வந்து என்னென்னா ஈல்டுங்கிற வார்த்தையை நீங்கள் ஆல்ரெடி வந்து அக்ரிகல்ச்சரில் கேள்விப்பட்டிருப்பீங்க. அதாவது இப்போ நீங்கள் ஒரு சீடை விதைக்கிறீங்கன்னா அது ஃப்யூச்சரில் எப்படி வரும் அப்படின்னு சொல்லிட்டு நீங்கள் இது பண்ணுறது அந்த ஈல்டு நம்ம கேள்விப்பட்டிருப்போம். ஸோ அதே கான்செப்ட் தான் இங்கேயும். இப்போ நீங்கள் வந்து கம்பெனியில் இன்வெஸ்ட் பண்ணுறீங்க. இன்வெஸ்ட் பண்ண போகிறப்போ மேபி அது ஃப்யூச்சரில் வந்து எப்படி வரலாம் உங்களுக்கு அப்படின்னு பார்த்தா டிவிடெண்ட்டாக வரலாம், இல்லை ப்ராஃபிட்டாக வரலாம், அப்படின்லாம் ஏர்னிங் அதாக வரலாம். ஸோ இதுதான் தான் வந்து பார்த்திங்கன்னா ஈல்டு மெத்தட் கீழே வரும். ஈல்டு இஸ் அ effective rate of return on investment which is invested by the investor. It always represent in the term of percentage. இது எப்போவுமே வந்து பர்சன்டேஜில் ரெப்ரசன்ட் ஆகும். Since the value of shares is made on the base of the yield, it is called yield based method. இதுக்கான ஃபார்முலா என்னென்னு பார்த்தீங்கன்னா expected rate of return divided by normal rate of return into paid up value per shares. இதுதான் வந்து yield மெத்தட்ஸோட ஃபார்முலா. அண்ட் நெக்ஸ்ட் வந்து பார்த்தீங்கன்னா எக்ஸ்பெக்டட் ரேட் ஆஃப் ரிட்டர்ன் வந்து நீங்கள் எப்படி அப்டேன் பண்ணுவீங்கன்னா ப்ராஃபிட் அவைலபிள் டு ஈக்விட்டி ஷேர் ஹோல்டர் டிவைடட் பை டோட்டல் பெய்ட் அப் ஈக்விட்டி ஷேர் கேபிட்டல் அமௌண்ட் இன்டூ 100 நீங்கள் போட்டிங்கன்னா உங்களுக்கு வந்து ஆன்சர் வரும். இப்போ கம்ப்யூட்டேட்டிங் ஆஃப் எ ப்ராஃபிட் அவைலபிள் ஃபார் ஈக்விட்டி ஷேர் ஹோல்டர்ஸ் அப்படின்னு பார்ப்போம். அதாவது என்னென்ன நம்ம எப்படி இதை ஃபார்மெட்டாக வந்து நம்ம வந்து சம்மில் அப்ளை பண்ணலான்னு பார்ப்போம். பர்டிகுலர்ஸ் இது வந்து பார்க்கலாம். பர்டிகுலர்ஸில் வந்து என்னென்னா ஆவரேஜ் ப்ராஃபிட் மைனஸ் டாக்ஸேஷன். ஆவரேஜ் ப்ராஃபிட்டை நீங்கள் மைனஸ் டாக்ஸேஷன் பண்ணணும். நெக்ஸ்ட்டு ப்ராஃபிட் ஆஃப்டர் டேக்ஸோட மைனஸ் ட்ரான்ஸ்ஃபர் டு ஜென்ரல் ரிசர்வ் பண்ணணும். ஆவரேஜ் ப்ராஃபிட் ஆஃப்டர் டேக்ஸ் அண்ட் ரிசர்வ் அது கூட மைனஸ் டிவிடெண்ட் ஆன் ப்ரிஃபரன்ஸ் ஷேர்ஸ் பண்ணணும். இதெல்லாம் நீங்கள் பண்ணிங்கன்னா உங்களுக்கு வந்து ஆன்சர் வந்து ப்ராஃபிட் அவைலபிள் டு த ஈக்விட்டி ஷேர்ஸ் ஹோல்டர் வந்து கிடச்சிரும். தான் வந்து பார்த்தீங்கன்னா ஈல்டு மெத்தட் கீழே வரும். அந்த ஈல்டு மெத்தட் ஆல்ரெடி 2 டைப்ஸ் இருக்குன்னு நான் சொல்லியிருக்கேன். ஒன்று பார்த்தீங்கன்னா டிவிடெண்ட் அண்ட் அனதர் ஒன் இஸ் வந்து ஏர்னிங். டிவிடெண்டுக்கு நம்ம ஃபார்முலா இல்லைன்னா வேல்யூ ஆஃப் ஷேர்ஸ் ஈக்குவல் டு expected rate of dividend by normal rate of dividend into paid up value of shares னு சொல்லுவாங்க. அதே வந்து செகண்ட் டைப் ஏர்னிங் என்னன்னா expected rate of earning by normal rate of earning divided by paid up value of shares னு சொல்லுவாங்க. ஃபார் எக்ஸாம்பிள் வந்து பார்த்தீங்கன்னா டிவிடெண்டுக்கு வந்து ஃபார்முலா வச்சு எக்ஸாம்பிள்னா இப்போ வந்து உங்களுக்கு வந்து expected rate of dividend வந்து 10, நார்மல் ரேட் ஆஃப் டிவிடெண்ட் வந்து 2 இருக்குன்னு அண்ட் paid up value of shares வந்து 10 இருக்குன்னு ஆன்சர் வந்து 50 வரும். அது போலவே வந்து ஏர்னிங்க்கு பார்த்தீங்கன்னா expected rate of earning 10, normal rate of earning வந்து 10,000, paid up into value of shares வந்து 10 இருந்துச்சுன்னா உங்களுக்கு வந்து ஆன்சர் வந்து 1 lakh வரும். ஸோ இது வந்து ஏர்னிங் மெத்தட், இது டிவிடெண்ட் மெத்தட்னு சொல்லுவாங்க. ஸோ நெக்ஸ்ட் வந்து பார்த்தீங்கன்னா ஃபேர் வேல்யூ மெத்தட், இந்த லாஸ்ட் மெத்தடு. ஃபேர் வேல்யூ மெத்தட்ஸ் ஆர் தீஸ் சம் அக்கௌண்டட் ஹூ டஸ் நாட் ப்ரிஃபரன் டு யூஸ் அ நெட் அசெட் மெத்தட் ஆர் ஈல்டு மெத்தட் ஃபார் த கரெக்ட் வேல்யூஷன் ஆஃப் ஷேர்ஸ் தே யூஸ் ப்ரிஃபரன்சஸ். அதாவது சில அக்கௌண்டன்ட் வந்து நெட் அசெட் மெத்தடும் அண்ட் ஈல்டு மெத்தட் ரெண்டுமே யூஸ் பண்ண மாட்டாங்க டியூ டு சம் ரீசன்ஸ். அவங்க வந்து ப்ரிஃபர் பண்ணுற ஒரு ஐட்டம் வந்து பார்த்தீங்கன்னா ஃபேர் வேல்யூ மெத்தட் யூஸ் பண்ணுவாங்க. It means a net asset method and yield asset method. The same provides a better indication about the value of shares than the elder two methods. ஃபார்முலா என்னென்னு பார்த்தீங்கன்னா intrinsic value plus yield value divided by 2. இது போட்டிங்கன்னாங்கன்னா உங்களுக்கு வந்து ஃபேர் வேல்யூ மெத்தடுக்கான ஆன்சர் வந்துடும். தேங்க்யூ.
Today I'll be talking about the buyback of ESOPs, which is the employee stock option plans. This entire presentation is split into 3 different parts. First part being what an ESOP is and why it is done. Second part indulges in the vesting period and the buyback of these ESOPs, along with a small example of how it works. Part 3 is an example taken from a TV show about a fictitious company and tries to explain the entire concept in that. So, as the name suggests, an employee stock option plan is for an employee. Let's get into it. What it is. So these employee stock option plans, as the name suggests, is an option for the employee to buy a share at a certain price which can be exercised within the company and it can be decided upfront. And this can be redeemed at a certain later point in the future, or it can be sold or bought later on. These ESOPs are given to the employees so that they can have a small ownership of the firm. So why an employee is given this 1x of the ownership of the company so that they can be motivated to stay in the company, their morals are increased and they would get more reward. They will get more money as the time passes by because it works as how a share works for the company. The thing is, these ESOPs can be only privately given for inside the company or can also be given publicly, which is also given to the open market. An open market is more preferred as there will be more amount of customers that come in. So why are these ESOPs done? So the thing is, any company, any startups that you take, they get very little funding. They may have funding to start off, but they need some more funding as they go on. They may earn cash, they may earn profits, but the thing is, these cash is mainly used for reinvestment purposes. They would use it to get more proper machinery, they would try to give it more for the employees. So the thing is, they would need more amount of funding for the company to still run. And they would turn to their employees for this because these people are loyal to the company. And if you give them a part of the ownership of the firm, they would be motivated enough to stay in the company and try to make it better. Thing is, once these employees get part of the share and they keep getting motivated to do more for the company, you actually get more amount of output, you get more amount of results, and this overall increases the company's valuation in the long term. Basically, the company's goodwill would increase, people would want to invest in this company. And the thing is, the main reason this ESOPs are done is so that you can bring in more amount of people along with the help of the employees that are also the pseudo owners, which means they are temporary or fake owners. We wouldn't say fake owners as such, but they are only there for a temporary basis. So, as the last line shows, if you give an employee a part ownership, it leads to more motivation, which gives more results, which includes like growth, or it will give more profits for the company, etc. So these ESOPs, they are given for a certain amount of time, which is what we will see in part 2 in the vesting period. So basically, these vesting periods, they talk about how an employee gets these stock options. For example, once they join the company, or once they're there for 2 years, or if they're there for more than 5 years. The thing is, these vesting periods can last up to 4 to 5 years. The first year is known as the first year cliff, where they get a very, very small amount of increases in the first year. And as the number of years goes by, according to the agreement they've made, it will increase. So for example, if I have 25% in the first year, 50 in the second year, 75 in the third year, it will become 100% in the fourth year. The thing why they keep these 4 to 5 years is so that they can retain the employees. So for example, if I have 25% in the first year, the employees, they would not be motivated to leave the company, as they know that they'll be getting extra 25% the next year. So this is also a motivation technique that is given for the employees to stay. And as the percentage increases over time, the amount of shares and the amount of money that they give is also increases over time. So when it comes to the main topic about the buyback, so what exactly is this buyback? So the thing is, it is the corporate action in which a company buy back their shares from existing shareholders or from open markets. So basically, once you give the people, the employees, or the open market their shares, and once these small startups, they start getting better in the environment and in the share market, the thing is, they tend to buy the shares that they're given back. The thing why they do is because an employee can buy these shares at a very low price, for example, $25. But the thing is, once the company gets better, they can probably sell it for $100 and they would make a profit of $75. So the thing is, they buy back these shares so that they can invest it back in their companies and they can grow. The one main thing that has to be noted over here is, people may think that what is so special about this ESOPs, they seem almost the same as dividends. The thing is, they are almost similar as dividends. The thing with dividends is, it goes back to the persons, but in these ESOPs, it is invested right back into the firm. So once they get these shares back, they can invest it in themselves and their earnings per share increases for the employees. So the process of these buybacks, the first one is to shortlist the candidates. Basically, they would try to find who bought these shares, whether they're the employees of the firm or they're in the open market. They would first make a list of who are all these candidates. The next one, they would give it to the board of directors of the company, and they will get the board approval for the buyback of these shares and utilizing the funds that they get from those. So the third one is the intimation letter. So basically, after the consent and confirmation from the employees or the people from the open market, they would send an intimating letter where they would cancel all the ESOPs and they would like take back all those shares and they would give the necessary compensation. They could be either paid with money or they could be given any other things based on the agreement. And finally, is this updation process with the registrar of the buybacks of these shares. So basically, under this updation process, you have to talk about the consideration paid and the shares that are bought back. You have to also give the information about the date of cancellation of shares and the date that physically these shares were destroyed. So some of the most famous examples that companies do for buyback would be of Swiggy or Flipkart. Basically, they would buy these shares at low and they would sell these shares at high. So, as I said in the beginning, I would give a very small example, for instance. So, for example, if I have 32 shares today, the company's value per share is 32 shares, and they have, for example, 1,000 of these shares. So that would amount up to $32,000. The thing is, in the future, for example, 5 years down the line, this becomes $50 per share, but the same 1,000 shares. So that would be $50,000. If a person, an employee, thinks about selling these shares, they would actually earn an $18 share of profit. So the thing is, if it's more than obviously this $32 is the profit, and if it's less than $32, it would become zero, it would be null, and it would absolutely be of no use. The thing is, like I explained before, you buy at a low price and you sell it at a higher price. That's the main profits that you get. Most of the people who try to invest in these firms try to find companies that buy back all these shares because that is now in the trend. Coming to the third part of the presentation is a famous example in one of the hit TV shows Two Broke Girls, where there are two cupcake owners who are trying to get their t-shirts printed. So they go to an American Ace, it's a t-shirt printing company, where they try to see everyone who works together, they're all happy. The thing is, they say they're a family. When we're trying to decode this, we can basically see the employees, any type of the employees who work here, they are all part owners of the company. So for example, if we have the marketeers, the designers, the customers who we can say as the open market, we can see the dyers, janitors, warehousers, anyone in the company, they have one small part of the ownership of this firm. So this, and in the future, if their company gets even more successful, they would buy back all of these shares. The thing is, all these employees are motivated to work in the company because they have a feeling that, okay, I'm a part of this company, I'm an owner of this company, so I should definitely give in all of my efforts to this. And that would honestly be it will result in more profits, goodwill, and etc. So coming to the end of this presentation, basically the buyback of these ESOPs is one of the most profitable and one of the most looked upon aspect of a firm, and more amount of investors are looking for companies who do this process. Thank you.
Wishing a pleasant day for the listener. I am Aruna Devi of BCom CA. From this presentation, we are going to learn about sweat equity shares. The learning outcome of this presentation would be meaning of sweat equity, uses of sweat equity shares, importance of sweat equity, conditions of sweat equity, merits of sweat equity, demerits of sweat equity, and an example. Let's move to the content. At first, let us learn about the meaning of sweat equity shares. Any business views employees as the driving force of its company. It's their diligence and effort that plays vital role in the development and growth of a business. Companies shows their appreciation for employees' work by rewarding staff in various ways. Reward not only show that you appreciate your staff, but rewards motivate employees to contribute further to establishment of business. Sweat equity shares are a kind of reward that companies give to their employees to show how much they appreciate the hard work put by the staff towards company. Section 288 of Companies Act 2013 describes sweat equity shares to simply explain the sweat equity shares are offered to certain employees or directors of the company for the following reason: remarkable contribution and efforts of an employee or a director in completion of any project, technical expertise in the field, value addition to the company through extraordinary contribution and gaining intellectual property rights. The companies tend to offer sweat equity shares to the employees to attract and retain the talent who helps the company to grow. When an employee has a sweat equity share, they can receive a part of company's profit as a return on their investment. The term sweat equity share refers to a person or a company's contribution towards a business venture or other project. The sweat equity share is generally not monetary, and in most cases it comes in form of physical labor, mental effort and time. The term sweat equity refers to person or a company's contribution towards a business venture or other project. The sweat equity is commonly found in real estate and construction industries, as well in corporate world, especially for startups. Sweat equity is an unpaid labor employees and cash-strapped entrepreneurs put into a project. Homeowners and real estate investors can use sweat equity to do repairs and maintain on their own rather than pay for a traditional labor. In cash-strapped startups, owner and employees typically accept salaries that are below their market values in return for a stake in the company. Sweat equity is a non-monetary contribution that individual or a founder of a company make towards company. Second, let's learn about uses of sweat equity shares or reason behind the issue of sweat equity shares. We know that sweat equity is a type of share offered to an employee, advisor or anyone in exchange for work done for the company. The first and foremost reason behind issuing a sweat equity share is to attract and retain the employees. In addition to incentives, sweat equity shares help in retention strategy with the compulsory lock-in period of 3 years and non-transferable shares. Also, offering such shares are more preferable in the initial stage when the future growth path of the company is unknown. Also, owning such shares give employees a business sense when they receive the right to vote and get dividends. Sweat equity shares are equity shares issued at a discount or for consideration other than cash by a company to its employee or directors. They are directly allotted to the employees at a discount price. These type of shares are preferred over ESOPs, Employee Stock Option Plan, as they offer the right to buy and it's not an obligation to buy the shares at a pre-decided price to be allotted in the future, thereby being dependent on the price volatility of the shares. In other words, it refers to the distribution of equity shares to the employee as a reward for their contribution and hard work in delivering intangibles to the business such as growth, success, profit, etc. A registered value assessor evaluates and determines the fair value of the sweat equity share. This serves the objective of rewarding an employee without much financial outgo. Sweat equity originally referred to the value enhancing improvements generated from the sweats of one's brow. So when people say they use sweaty equity share, they mean their physical labor, mental capacity, and time to boost the value of a specific project or venture. It can be issued to reward an extraordinary director who goes out of the way of company's growth. Sweat equity can be issued to such director to acknowledge their efforts and keep them interest and continue in engagement for the upcoming future of the business unit. Before learning the importance of sweat equity, let's learn who can issue sweat equity shares. Which parties can issue the sweat equity shares to company or employees? First one person company. Next, public company. Private company. Section 8 companies. Listed or unlisted companies. Next, which employees are covered under the sweat equity share scheme? Employees covered under the scheme as per Section 288 of Companies Act 2013 are directors and employees. Employee. Who are employees? Employees are the backbone of any company or any business, as their diligence and hard work play a crucial role in growth of business. Many companies appreciate their employees and reward them in different ways. Rewarding employees motivates them to contribute more towards growth of business. Sweat equity is such kind of reward. The employees who are listed under this are a person who is working on a permanent position in the company in or from outside of India for at least a year. A director of a company, irrespective of being a whole-time director or not. An employee or a director as defined above of the entity's holding or subsidiary company in or outside India. They are defined as employees. Now let's learn about importance of sweat equity. Sweat equity is valuable as cash equity. You may think that since we are putting in the effort and toil, it may have less value. But ask any business owner or real estate agent, they would tell you that because homeowner put in effort to make improvements for their house, the house can be sold at a decent profit over and above the normal price of the house. A business owner knows the value of sweat equity because at the beginning of running an enterprise, most of their focus should go on effort and toil they put in for money to come in. Sweat equity is useful when cash isn't enough. This is just the extension of earlier point. In beginning, a business owner doesn't have much money, but they have lot of time. They can put in their effort during the time and can earn cash with the cash isn't enough. Sweat equity can be paid back in future. When a company starts its journey, it hires employees stating that they would be paid sweat equity. What does it mean? It means that owner knows the value of the effort and his employees' time. But since there is no cash coming in, the employees can be paid in equity share. When the business receives money, the employee would be paid based on its value if they want to sell their stakes. Equalizer. It monetizes expertise beyond the financial aid. Claim to equity. Offer equity as compensation by evaluating team's effort. Increases company's valuation. Funds can be raised without risking debt accumulation. Now, let's learn about how sweat equity shares really work and the rules and conditions of sweat equity share. Sweat equity shares, how does it work? Sweat equity originally refer to the value enhancing improvements generated from the sweat of one's brow. So when people say they use sweat equity, they mean their physical labor, mental capacity, and time to boost the value of specific project or venture. The term is commonly used in real estate and construction industries. Sweat equity can be used by homeowners to lower their cost of home ownership. Real estate investors who flip houses for profit can also use sweat equity to their advantage by doing repairs and renovations on property before putting them on the market. Paying carpenters, painters, and contractors can get extremely pricey, so renovation using sweat equity can be profitable when it's come time to sell. Sweat equity is also an important part of corporate world, creating value from the effort and toil contributed by a company's owner and employees. In cash-strapped startups, owner and employees typically accept salaries that are below their market value in return for a stake in company, which they hope to profit from when the business is eventually sold. Cash-strapped business may provide compensation for an employee's sweat equity in another form such as shares in company. In many cases, people have to use sweat equity, their time and effort to contribute the success of company. That's because there are very little capital to pay salaries. Unless you are owner, everyone except to be paid for their time and energy. After all, no one wants to work for free. While a company may not yet have enough capital to pay its employees, it can provide compensation in other forms. For instance, startups may provide key employees with an equity stake in company. Other more established company may provide employees with shares in corporation as reward for their sweat equity. Rules and regulations or condition must be followed in case of issuing of sweat equity, or it should be issued to employees to reward employees. Issued for consideration other than cash. It must be allocated within 12 months of special resolution. It must be disclosed in company statement. It must not exceed 25% of total company's equity at any time. Merits or benefits of sweat equity. We know that sweat equity shares which are issued by a company are only to its employees or for directors at a discount for other than cash consideration, means not for non-cash consideration. By this way, it creates incentive. Since the value of an equity stake increases as a startup's value rises, those who are paid either in part or in whole in the form of sweat equity will even be more driven to their best work to help companies succeed, and by extension cause their stake value to go up as well. As it saves money. Many young businesses are strapped for cash and are searching for way to cut costs. However, they cannot. Offering company equity as a form of compensation will thus help such businesses save money as they expand and become more profitable. It attracts top talent and skills. Offering equity to valuable employees who might not be able to afford otherwise will help you attract top talent and skills to your startup. This can be extremely beneficial to young businesses in need of specific skills, resources, or quality networks. It rewards for exception value addition for key employees. It is a kind of good or useful motivational incentive tool. Non-cash compensation tool for employees. It releases or free cost share acquisition by employees. It is a long-term wealth creation for employees. It benefits in terms of long-term capital gain. Limitations or demerits of sweat equity. First, difficult to value. Forming a definite consensus about how to value sweat equity can be difficult for a founder. Is it just about how much money someone can make in a given position? It is the additional value that a person's work brings to company. In the end, the exact worth of sweat equity is determined by the startup, and it's a tricky thing to value. Second, can result in disputes. The uncertainty surrounding the valuation of sweat equity can lead to potential internal conflict. For instance, in some cases, employees might believe that their contributions are more valuable than what employees values them to be. This can cause internal tension, which can have a negative effect on the whole venture. Third, causes unpredicted delays. Sweat equity, when valued correctly, does a good job of aligning motivations and deliverables, but might also have unintended negative consequences. If you are offering only shares instead of money for work done, keep in mind that people can't subsist on shares alone. How do you expect that individual to survive and pay their bills if you only offer shares in return for their work done? If a person does not have enough money in the bank to cover basic expenses, they will be forced to work a second or third job in addition to what they are doing for you, limiting the amount of time and headspace that they will devote to a project. The same is true if you offer a business sweat equity. If the company does not have enough money to pay its employee, it will be forced to take other contracts, which will delay the completion of project or dilute the quality of work put into it. Conditions that equity shares must follow, or it must follow these conditions authorized by special resolution in general meeting. Number, price, consideration, and classes should be specified in the resolution. The company must complete at least 1 year. Equity shares of those company must be listed in a recognized stock exchange. These conditions should be followed to issue sweat equity shares. Now, let's understand the concept of sweat equity shares through few examples. For a new enterprise, expending sweat equity can help saving money. Sweat equity is especially important for cash-strapped startups, which generally offer below the market. Sweat equity describes the physical and mental effort and time spent in creation and maintenance of business enterprise. Uncompensated work in common sectors like real estate, construction, startups, especially in early stage of business. Expending sweat equity might be a solution to save money or a way to work for less with the expectation of bigger payday in the future. In early stage of company's life, when there is a shortage of cash to offer such compensation for effort and the time entrepreneurs spend sweat equity. Below are some examples. First one, startup company. For example, A software developer creates a new app while working a day job, so the developer completes the DIY coding and design for app on nights and weekends. Finally, the developer receives interest from an angel investors who want to buy 25% stake in companies for $250,000. This puts total value of companies at $1 million. The developer might value their time and effort, their sweat equity at $1 lakh. In percentage terms, they have 10% sweat equity in recently valued company. Second one, for construction. Some with skills in the construction trade builds a house. In addition to cost of material, they work long and hard hours to finish new home. In essence, the effort they have expended in sweat equity, if they sell house for $675,000, they would subtract the amount in materials, fees and other upfront cost. Depending on how they valued their time and effort, that portion of sale price would be the sweat equity stake. The new business. For example, some friends decide to start a small business together. They pool resources to buy equipment and materials, collaborate on a business plan, and work in their free time to get the business running. Finally, the business starts to earn revenue. Private equity investors approach the business owners to buy stake in the company. They accept and the company later goes public. The business owners make a sweat equity agreement in form of sweat equity shares of the company. If the share price of a company is $20 and each member calculates their sweat equity to be $80,000, each founding member would receive 4,000 shares of sweat equity. Let's say another example. An entrepreneur who invested $1 lakh in their startup sells 25% of stake to an angel investors for $5 lakhs, which gives the business a valuation of $2 million or $5 lakh divided by 0.25. Their sweat equity is the increase in value of the initial investment from $1 lakh to $1.5 million or $1.4 million. Let's understand the concept of sweat equity elaborately. Sweat equity shares are given to employees and directors of a startup corporation for their efforts toward the startup, commitment to the company, or under professional understanding of industry, or employees who have quality experience or have greatly contributed towards the startup's intellectual property rights. In exchange for the investors' money, founders, top-level employees, directors are given opportunity to share a portion of their profit from form of securities. The shares are given away at a discount for non-cash consideration. Sweat equity shares are primarily used by startups in cases where funding is limited and sweat equity makes compelling form of compensation. Sweat equity shares also provide valuable in big, well-established firms, as these companies have significant fund to invest their market and receive securities in return. This return can be shared with startups' hardworking employees who might be entitled to such incentives in addition to their remuneration. Sweat equities refers to the contribution made by owners and employees towards the company in consideration other than cash. It is beneficial for startups that do not have enough hard money to invest in operation of business. For example, let's take a partnership firm where some members contribute in form of cash and others contribute their time and efforts towards the common objective of the firm. Therefore, we see there are two types of contribution towards the firm's capital, cash, and the other is sweat equity in form of time and effort. It is counted equivalent to the cash equity and distributed in equities, stock to the owners and employees. An example of sweat equity is a person who spends time renovating home and selling them at a higher price. The difference between the value of home before renovation and the market value of the home after repairs represent the sweat equity. For example, real estate before and real estate after renovation is equal to sweat equity. Sweat equity will be equal to the value of real estate property before and after sweat equity being invested. Sweat equity is an ownership interest in a business that was due to labor rather than the investment of funds. It recognizes the amount of work contributed to a business. A common form of sweat equity arises when investors buy a rundown property and then personally spends a substantial amount of time of renovation the project. In case the investor's efforts translate into a substantial increase in the value of real estate. In a startup company, some of the original partners are awarded shares in exchange for invested funds, while others are awarded shares in exchange for the efforts in running the business. How was value addition defined? According to Rule 8.1 of Companies Rules 2014, value addition is defined as the actual or anticipated economic benefits that are generated by employees or directors and are either derived or yet to be derived by company. How many sweat equity shares a company can issue? There are few conditions for issue of sweat equity shares. A company is allowed to issue the following number of sweat equity shares only. First, 15% of current paid up equity share capital in a year. Second, equal to value of rupees 5 crore. Also, the sweat equity shares shouldn't go beyond 25% of paid up equity capital of issuing company at any point of time. However, there are exceptions for startups, as they are allowed to issue up to 50% of paid up capital within 5 years from the date of registration or incorporation. Valuation of sweat equity shares. As mentioned earlier, a registered valuer is hired to identify the value of intellectual property rights or know-how value addition created with respect to company that wishes the issuance of sweat equity shares. The registered value determines the fair price of sweat equity shares, and they are also expected to justify the valuation drawn by them. Significance of sweat equity shares. First, most startups at the primary stage are unable to reward their employees in cash or other monetary rewards. Hence, it makes sense to reward employees with sweat equity shares. This is not limited to startups, as well as recognized companies also can do this. Offering employees sweat equity shares is a way of recognizing their hard work and efforts. This kind of acknowledgement motivates them to stick with the company longer. Sweat equity shares are preferred as they negate the need to raise paychecks by taking on debt. If an employee got pay cut at any point, sweat equity share make up for the lost money. Taxability of sweat equity share. Sweat equity share are taxable in hands of employee when allotted or transferred under the following conditions. If shares offered to the employee are defined in Section 2H of Securities Contract Regulation Act 1956, If shares are allotted or transferred or after 1st April 2009, any securities allotted or transferred before the date under the ambit of fringe benefit tax. If sweat equity shares are directly or indirectly given to employee or former employee. When such shares are given by employer or form of employer. Even when shares were allotted free of cost or at a discount price. If any of the above conditions are satisfied, then sweat equity shares will be taxed in hand of employee in the year which such equity shares were allotted or transferred. To conclude, equity shares proved to beneficial to both employees and the issuing company. Sweat equity shares help in retaining the best employees and generating capital for future expansion without relying on debts.